Should you let a trade become an investment? Well, the answer is yes and no. I think that whenever you hear that statement, you should never let a trade become an investment, is really on the downside. If something's losing you money, you got to puke it out. You have to know where you're getting out beforehand. But if you have a winning trade, why not let the thing run? In my book, The Inner Voice of Trading, I described a situation very, very early on for a newer trader who doesn't really necessarily know if he or she has any skill or if they're just lucky. And you have five equally weighted positions. One's up 25, one's up 10, one's flat, one is down 10, the other one's down 25. So you can see the symmetry here. Despite putting on five equally weighted trades, the account balance is zero, despite having some decent growth, at least in the first two names, plus 25, plus 10. It's not until you employ a little money management technique where you, say, cauterize the number five position at down 10, now you're up something like 3%, and you don't even know if you're good or you're lucky. So I think that statement is true, but only kind of half the time, right? It only makes sense to cut your losers. If you have winning trades, you might as well let them run, even if you trade index futures, because those things can run too. What I try to teach is to make sure that you're not creating more work for yourself. In other words, I don't want you to have to reinvent yourself every morning. If you have winning trades, which to me are hard enough to find in the first place, you might as well stick with them. And if you're scared about overnight risk, you can always position size, right? That's where we make and lose our money. Now, a few of you written in about how many trades do you make, all this and that. It's really not important. It's not going to help you trade better just to have it for instance. And two, I don't really care for voyeuristic kind of stuff. But I will say this, that for the systematized rules, we put on all of those trades. For the discretionary trades, those setups are harder to find. Plus, for my taste and preference where I am in my career, I'm not working for 2-to-1 type of payoff ratio. I'm really looking for 3-to-1 minimum, better yet, even 5 or better. Because for the risk that I'm willing to take, I really want to get paid. I'm not in it for the action. So there are days that go by where I don't have trades, just to give you a for instance. I have access to simulators. I don't necessarily use them because I know my rules off the top of my head. And after several decades, I can kind of see the trades that would show up in the system. Does that make sense? Because I program the system anyway. So there's a couple of good systems out there that can help you with the money management and help you backtest your ideas if you want to see what the worst case scenarios are overnight. I would say that over my career, there have been 3 or 4 instances where I took big hits overnight. But by big hits, I'm talking like 2%, maybe 3% to my overall equity. I feel like people have, I don't want to say irrational because that means something specific in the world of psychology, and I'm not a psychologist, but it does seem a little irrational that people have this fear about taking risk home overnight or over the weekends when it's really not that bad at all. If you're trading too large, then yes, by all means. But you should also know when you study the data that the biggest worst days, if you're long, are also really close to the better up days, at least when I look at the data. So you can get the data for free. If you go to Yahoo Finance and you click on your ticker, you click on the ticker that you're looking at, you can look in the left-hand column, and I think it'll say historical data. You could put in a date range. I would look at 10 years. You'll get the data in a CSV file, and you could put that in your Google Sheets or Excel, whatever you're using, and look at the data and see what the results were overnight versus what happens intraday. I've done studies on that. It's very surprising how much money you can make just by being in winning trades and holding them overnight over the weekend. So how did I come to understand this? Well, like you can imagine, idiot Mike, I've done this, for 36 years now, and I had to learn the hard way. I found out, because I came from the wirehouse background, and the wirehouse coached you to use the firm's research. That's your first misstep. Now, these are really bright people. I've taught CFAs. I've got nothing against them. But the reason they do that is because of compliance. If you're going to have a client lodge a complaint, you better have documentation, right? So the firm basically said, if we have this research department and those folks who are smarter than you in terms of analysis are going to kick the tires and we have buy recommendations on these things, you're never going to lose, because it's not a crime to lose money. What you don't want to go doing is picking names that no one's ever heard of, go to the pink sheets, this and that, because then we can't support you if it ever comes down to arbitration. So rely on the firm's research, especially if you're going to make solicited calls, right? We talked about that. So you find yourself in the situation where you have five names of equal weights, plus 25, plus 10, flat, minus 10, minus 25. And then you're in a situation where you know all the names because they're all brand recognized. They're all blue chip names. So now you've become emotionally attached to the name beforehand because you can see the good or services that exist in the world. So for me, that was a tough one to have to come over, is that I had to be, the word I use is promiscuous or very disloyal. You can't fall in love with the ticker because you think you know the company or you want it to win like it's your favorite sports team. You have to dissociate from that and be promiscuous enough to know that if this thing ticks against you, that's a form of cheating. That's like your partner cheating on you, and it's betrayal. So therefore, it has to go. There can't be any loyalty to it. I don't care if it's Disney, Coke, Nvidia, Bitcoin. It doesn't matter. If you're starting to take on water and lose money, it has to trade. One of the smartest things I ever heard was from Alan Ace Greenberg, who was chairman of Bear Stearns. And, Bear Stearns back in the day, in case you don't know, had very, very strong proprietary trading. And one of the rules that he had for his traders when he actually was on the floor was that if you bought a name on Tuesday, come to Friday's close, if you still had it and it was down, doesn't matter where your protective stop was, meaning the stop wasn't hit but you were still down, he didn't take losers home over the weekend. Everything traded. It could be AT&T, could have been General Electric. It did not matter. If it was down, but coming into Friday's close, 4 o'clock Eastern time, they puked it out. And he would really put people through the ringers as to why they would try to justify taking losing trades home. So that much I understand. That's when you don't want an investment to become a trade to become an investment, because you're emotionally attached. Like, hey, what happens? You're down, you start losing a little bit of money, but you're like, man, it's Nvidia. It's never going to go out of business. But you have to remember there's like a 75% chance at any given time that the name could go through, a 50% drawdown. You don't know where it's going to start. You can use reversals for sure, and there's probably support and resistance that you can use before it would ever get that bad. But that's when I think people run into trouble, and the statement would be true. It's like, if you buy the thing long, don't become emotionally attached to the ticker. Despite what you can see in the media, the truth is you probably don't know anything about the fundamentals. If you're not a CFA, you can only see what you're seeing on the internet. And to me, that's information. I don't know that it's really research. So I've learned to train my mind to not look into stuff that amateurs are coming up with, because it makes me feel good to see another person. Hey, Yankee fan, you're walking down the street, you got a Munson jersey on. That's all great. But at the end of the day, it's up for you, and it's your responsibility to manage the risk. And man, I learned the hard way, because I'd have like Wendy's or McDonald's, I'd have GE, I'd have anything in the Dow 30, because you're like, how could it go wrong? It's in the stock index. Obviously, other people really smart, it wouldn't be in the index if it wasn't a great name. But you find out that you can lose money with McDonald's, you can lose money with Walmart, you can lose money with these big blue chip names. And so this exercise throws into sharp relief that you have to remain objective. Right? You're looking for candidates who are going to step up, and if you buy them long, are going to immediately start to perform for you. And if you don't, it's the double bye-bye. Get out of my portfolio. There's no time for that. And if it ticks down, you could make an argument to get out of it before your protective stop is even hit. Or if it stalls and it's not really plus or minus anything material after a day or two, you employ a time stop and get out, because whatever you thought was going to happen, either you're really early or the momentum is stalled and it's time to go. But I don't think that statement, don't let a trade become an investment, is an absolute rule. I think if you have winners, and as long as you know how to manage the risk, and you're putting on an appropriate amount at the beginning, and you might have rules to scale out, you obviously have rules to adjust your protective stop so that if it does reverse against you, I just see too many people doing too much work for too little money and having to reinvent themselves every day. Where if you can find a strongly trending name, you know, and go to school on yourself. If you were short Tesla, how much did you take out of that trade? Because, you know, if it's less than 10%, you left the majority of the money on the table. If you even took $25 or $50 out of the Nvidia move recently, you left the majority of the money on the table. And yes, you can celebrate the wins all you want, but your goal is to maximize your behavior. You want to optimize your behavior. So for me, you know, I would say when you hear people say that, they're not really sure about managing risk, because there's nothing to fear about keeping good risks in your portfolio. Good risks are the trades that you have that have unrealized gains. I wrote a lot about this in The Inner Voice of Trading. You can get the link to the audiobook version. It's for free in the description here. If you like this video, there's more right here.